I learned a long time ago that the market doesn't reward intelligence, and it certainly doesn't reward emotion. It rewards discipline. That lesson cost me more money than any tuition ever could. I didn't lose because I didn't know enough. I lost because I felt too much. And maybe you know what I mean. Haven't you ever seen a trade go against you and felt that tightening in your chest, that urge to do something, anything, just to stop the pain? That's where most traders go wrong. They think trading is about being right. It isn't. It's about following rules when every nerve in your body is begging you to break them. The market doesn't care how confident you feel, how hopeful you are, or how badly you want the trade to work. Price moves when it moves, and it doesn't stop to ask for your permission. The only thing you control is your behavior. So the real question is, can you control yourself? I've watched men with sharp minds and good charts blow up accounts because they couldn't sit still. They saw a small loss and turned it into a big one because they couldn't admit they were wrong. Or they saw a profit and grabbed it too early, afraid it might disappear, fear and greed. Those two emotions have emptied more trading accounts than bad analysis ever has. You can draw the finest lines on a chart, but if you don't respect your rules, those lines mean nothing. When I say, follow rules, I don't mean vague ideas you remember only when it's convenient. I mean rules that are written down, tested, and obeyed. Rules about when you enter. Rules about when you exit. Rules about how much you risk. And once you're in a trade, the decision-making should already be over. Have you noticed how calm trading feels when the plan is clear, and how chaotic it feels when it isn't? The tape tells its story one price at a time. It doesn't shout, it doesn't argue, it just prints. If the market confirms your idea, you stay with it. If it contradicts you, you step aside. That's not weakness. That's professionalism. The amateur fights the market. The professional listens, and listening requires silence inside your own head. Most traders don't actually lose money because of one bad trade. They lose money because they abandon their system after a string of emotions takes control. A loss makes them angry. A win makes them reckless. And suddenly they're trading to feel something instead of trading what they see. Have you ever taken a trade just to get back what you lost? That's emotion talking, not price. Your rules are there to protect you from yourself. They are your defense against impatience, ego, and hope. Hope is especially dangerous. Hope has no place in trading. Hope makes you hold losers and sell winners. Hope makes you ignore the chart because you feel the market should turn. The market doesn't turn because you hope. It turns when supply and demand shift, and the chart will tell you when that happens, if you're willing to wait. Waiting is one of the hardest skills to learn. Doing nothing feels like failure to most people. But in trading, doing nothing is often the smartest position you can take. I made my real money not by trading all the time, but by trading at the right time. I waited for the market to line up with my rules, and when it did, I acted without hesitation. Can you see the difference between patience and fear? Risk control is another rule traders love to bend. They tell themselves, just this once, I'll risk a little more. That sentence has ended more careers than bad markets ever have. The market offers endless opportunities, but your capital is finite. If you don't respect that, the market will teach you the lesson the hard way. Small losses are part of the business. Big losses are a choice. Charts don't predict the future. They organize the present. They show you where price has been accepted and where it has been rejected. Your rules turn that information into action. Without rules, a chart is just lines on a screen. With rules, it becomes a decision-making tool. And once the decision is made, your emotions no longer get a vote. Doesn't that sound like freedom? The money mindset of a successful trader is built on survival first. Profits come second. If you stay in the game long enough, the market will eventually give you opportunities. But only if you're still solvent, still focused, and still disciplined. Emotional trading shortens your career. Rule-based trading extends it. Wealth in trading is not about excitement. It's about consistency. Every time you break a rule and get away with it, you reinforce bad behavior. That's a dangerous thing. The market may let you win today, but it will collect tomorrow. Rules must be followed especially when they feel uncomfortable, especially when your emotions tell you that this time is different. The market loves to punish that belief. Have you ever noticed how the biggest losses often start with confidence? I always trusted the market more than my opinions. Opinions change, feelings change. Price is the final judge. When the chart says I'm wrong, I accept it and move on. No drama, no revenge, just another small expense in the business of trading. That mindset didn't come naturally. It was earned through mistakes, losses, and hard self-examination. If you want to last in this business, you must become boring. Boring entries, boring exits, boring risk. The excitement you feel when trading emotionally is the same excitement gamblers feel. Traders who build wealth don't chase that feeling. They chase alignment between price and rules, and when that alignment disappears, they step back. The market will always test your discipline. Every day, it asks the same question: will you follow your rules, or will you follow your emotions? Most days, the answer decides your results long before the trade is over. And once you understand that, you begin to see trading not as a battle with the market, but as a conversation with yourself. Because in the end, the chart is honest. The rules are clear. The only uncertainty left is how you will act when the pressure is on. Every broken rule trains bad habits, and the market never forgets the habits you teach yourself. That's a lesson most traders learn too late. You don't wake up one day and suddenly become reckless. You train yourself into it, one small exception at a time. One rule bent here, one stop ignored there. It doesn't feel dangerous in the moment, does it? It feels reasonable. It feels justified. And that's exactly why it's so costly. The first time you break a rule, there's usually discomfort. You know you shouldn't be doing it. Your plan says one thing, your hand does another. But if the trade works out, something changes. The discomfort fades. The mind starts connecting rule, breaking with reward. Have you noticed how quickly that connection forms? The market pays you once for bad behavior, and suddenly your discipline is negotiable. That's how bad habits are born in trading. Not from losing, but from winning the wrong way. A trader who loses after breaking a rule might still learn. A trader who wins after breaking a rule learns the wrong lesson. He starts trusting impulse instead of structure. He starts believing he has a feel for the market. And the market is always patient enough to let that belief grow before it takes the money back. Rules are not there to be admired. They are there to be obeyed. The moment you allow exceptions, you introduce subjectivity, and subjectivity opens the door to emotion. You start asking questions you shouldn't be asking while in a trade. Maybe I should give it more room. What if this is the big move? It's only a small position. Those thoughts don't come from the chart. They come from wanting to be right. Every broken rule weakens the next one. You don't just break a stop loss once. You break it, then you move it, then you remove it entirely. And by the time the loss becomes painful, the habit is already formed. The market didn't force that loss on you. You trained yourself for it. Can you see how dangerous that is? Trading is a business of repetition. You do the same things again and again. That works in your favor when your rules are sound and followed. It works against you when your behavior is sloppy. The market doesn't care if you break a rule once or 100 times, but your mind does. Your mind records it. It remembers that you survived, and next time, it pushes a little harder. Most traders think discipline is about willpower. It's not. Discipline is about removing choices. Rules eliminate decisions in moments of stress. When you break a rule, you bring choice back into the trade. And choice invites emotion. Emotion invites rationalization. Rationalization invites losses that don't belong on your ledger. A trader who respects rules doesn't argue with the market. He doesn't negotiate with price. He accepts outcomes quickly and moves on. A trader who breaks rules stays mentally tied to the trade long after it should be over. He watches every tick, hoping, fearing, reacting. That emotional attachment is a habit too, and it grows stronger every time a rule is ignored. Think about how habits are built anywhere else in life. One skipped workout becomes two. One missed budget turns into debt. Trading is no different. The chart doesn't change because you broke a rule. Only your standards do. And once standards slip, results follow. Have you ever looked back at a big loss and realized it started with something small you told yourself didn't matter? Rules create distance between you and your emotions. They act as a buffer. When you remove that buffer, the market hits you directly. Every fluctuation feels personal. Every pullback feels like a threat. That's not trading. That's reacting. And reaction is always late. The professional trader understands that his greatest opponent is not the market, but inconsistency. Inconsistency comes from habits, and habits come from repeated behavior. Break a rule once, and you plant a seed. Break it again, and you water it. Eventually, it grows into a pattern you can't control under pressure. That's why the smallest rules matter most. Position sizing, entry confirmation, stop placement. These aren't details. They are foundations. Ignore them, and everything built on top becomes unstable. The market will test that instability at the worst possible time, usually when confidence is highest. A disciplined trader doesn't ask whether a rule feels right today. He asks whether the setup meets his criteria. That's it. No debate. No emotion. The habit is execution, not interpretation. The more you follow rules, the easier it becomes. The more you break them, the harder discipline feels. Isn't it strange how the market mirrors your internal order or chaos? You can't build wealth in trading by being occasionally disciplined. Discipline must be automatic. Automatic behavior comes from habit, and habit is shaped by what you allow yourself to do when no one is watching. The market is always watching, even when it's quiet. If you want to know where your future trading results are headed, don't look at your last trade. Look at how often you bend your rules. Look at how quickly you justify it. That's the real signal. Because long before the account balance changes, the habits have already decided the outcome. And once a trader understands that every rule broken is a habit trained, he starts to see each decision differently, not as a chance to make money, but as a vote for the kind of trader he is becoming. Consistency comes from repetition, not intuition, and that truth runs against what most traders want to believe. Everyone likes the idea of having a special feel for the market, some inner sense that tells them when to act. It sounds impressive. It sounds intelligent. But the market has a way of exposing that illusion over time. Intuition without structure is just emotion wearing a smarter mask. And emotion, no matter how well dressed, still leads traders into trouble. I used to believe that after enough experience, I would simply know when to buy and when to sell. I thought time in the market would sharpen my instincts until they were reliable. What I learned instead was that experience only sharpens habits. If the habits are poor, experience makes the damage faster and larger. Have you ever noticed how some traders lose money more efficiently as time goes on? The market doesn't reward flashes of brilliance. It rewards those who do the same right thing over and over again. Repetition builds familiarity, and familiarity builds confidence that doesn't depend on mood or opinion. When you trade the same setup repeatedly, you stop guessing, you stop hoping, you start recognizing. The chart stops being a mystery and starts becoming a pattern you've seen before. Intuition feels good because it makes trading personal. It makes you feel involved, clever, even important. But consistency requires the opposite. It requires you to step aside and let the process work. The trader who relies on intuition is always slightly different from day to day. His decisions change with his emotions, his last trade, his level of fatigue. The trader who relies on repetition shows up the same way regardless of how he feels. Which one do you think the market favors? Every consistent trader I've known did fewer things, not more. They traded fewer setups. They followed fewer rules. But they followed them with precision. Repetition stripped away unnecessary decisions. The same entry criteria, the same risk limits, the same exit logic, day after day, trade after trade. That's how results smooth out over time. Inconsistent traders are always searching for a better indicator, a better strategy, a better feeling. They jump from method to method because nothing feels reliable. What they don't realize is that reliability comes from execution, not discovery. You can't measure a method you don't repeat. You can't trust results that come from improvisation. Have you ever tried to improve something you refuse to do the same way twice? Repetition does something important to the mind. It removes drama. When you've seen the same setup 50 times, the outcome of any single trade stops mattering so much. Losses don't shock you. Wins don't excite you. You know both are part of the sequence. That emotional neutrality is not coldness, it's clarity, and clarity is what allows consistency to exist. Intuition, on the other hand, thrives on novelty. It wants to feel something new. It wants to react to every tick, every headline, every sudden move. That kind of trading keeps you busy, but it doesn't keep you profitable. The market is full of noise, and intuition loves noise. Rules filter it out. Repetition strengthens that filter. A trader who repeats a process begins to trust it, not because it always wins, but because it behaves as expected. Losses occur where they should. Profits appear where they should. There are no surprises. That predictability is not about price direction, it's about behavior. And predictable behavior is the foundation of consistent results. Many traders mistake intuition for experience. Experience is not a feeling. Experience is data stored through repetition. It's knowing what usually happens after a certain pattern forms, because you've traded it enough times to see the distribution of outcomes. That knowledge doesn't shout. It doesn't rush. It quietly waits for confirmation. Isn't that different from a gut feeling that demands immediate action? Consistency also protects you during difficult periods. When the market changes character, intuition becomes unreliable because it is tied to recent success. Repetition anchored in rules adapts more slowly, but more safely. It keeps you from overreacting. It keeps you from reinventing yourself after every drawdown. It keeps you grounded when confidence is shaken. Wealth in trading doesn't come from one inspired decision. It comes from thousands of ordinary ones executed correctly. That kind of wealth-building mindset doesn't chase excitement. It values durability. Repetition compounds not just money, but skill. Each correctly executed trade reinforces discipline. Each followed rule strengthens identity. The trader who depends on intuition often trades to feel in control. The trader who depends on repetition gives control to the process. That surrender is not weakness. It's acceptance of how markets actually work. You cannot impose your will on price. You can only respond to it in a consistent way. When repetition becomes habit, trading becomes quieter, fewer internal arguments, fewer second guesses. You stop asking what you should do and start doing what you've already decided. That shift changes everything. Stress decreases. Focus increases. Results stabilize. Consistency is not exciting to talk about. It doesn't make for dramatic stories. But it is the difference between traders who survive and traders who disappear. And the irony is that most traders are only inconsistent because they're trying too hard to be exceptional. The market doesn't require you to be exceptional. It requires you to be reliable. And reliability is built one repeated action at a time, long before intuition ever earns the right to speak. Risk control is emotional control in disguise, and most traders don't realize that until the market teaches it to them the hard way. They think risk is a mathematical problem, something solved with position size and percentages. That's only half the truth. The real purpose of risk control is not to protect the account from the market, but to protect the trader from himself. Because when risk is uncontrolled, emotions are unleashed, and once emotions take over, logic doesn't stand a chance. Every strong emotion in trading is tied to size. Fear grows when the position is too large. Greed grows when the potential gain feels life-changing. Hope grows when the loss feels unbearable. None of those emotions come from the chart itself. They come from exposure. Reduce the exposure, and the emotions lose their grip. Isn't it interesting how calm a trade feels when the risk is small and defined? Most emotional mistakes don't start with bad analysis. They start with bad sizing. A trader risks too much, and suddenly every tick matters. The mind starts tracking profit and loss instead of price behavior. The chart fades into the background, replaced by internal noise. That noise whispers things like, "Just give it a little more room," or "Don't let this turn into a loss." Those thoughts don't appear when risk is controlled. They only show up when the position is heavy. Proper risk control creates emotional distance. It allows you to see price movement without feeling attacked by it. A pullback becomes information instead of a threat. A stop loss becomes a business expense instead of a personal failure. That shift is subtle, but it changes everything. Without it, trading becomes reactive. With it, trading becomes observational. Many traders try to fix emotional problems with mental tricks. They tell themselves to be calm, to be patient, to be disciplined. But discipline is fragile when risk is excessive. You can't reason with fear when the account is on the line. You can't think clearly when a single trade feels like it will define you. Risk control solves this not by strengthening the mind, but by removing the pressure that overwhelms it. The market tests emotional weakness through volatility. Sharp moves, sudden reversals, unexpected pauses. If your risk is too large, these movements feel intolerable. You start interfering with trades. You move stops. You exit early. You re-enter impulsively. All of that behavior is emotional, but its root cause is poor risk management. Have you ever noticed how your best trades often come when you feel strangely detached? A trader who controls risk doesn't need courage. Courage is required only when you've put yourself in danger. When risk is correct, execution becomes routine. You're not brave for taking a trade. You're simply following your plan, and when the plan fails, you accept it without drama. That emotional neutrality is not accidental. It is designed through risk limits. One of the biggest illusions in trading is the belief that more risk equals more opportunity. In reality, more risk usually equals less clarity. You stop thinking in probabilities and start thinking in outcomes. You want this trade to work. You need it to work. And the moment you need a trade to do anything, you've lost objectivity. Risk control keeps trades small enough that no single outcome matters too much. That's where consistency is born. You can't be consistent if you're emotionally hijacked by every decision. And you can't be emotionally steady if your risk fluctuates with confidence or recent results. Fixed risk creates stable behavior. Stable behavior creates reliable performance. Wealth building in trading is slow and uneven. There are drawdowns, flat periods, streaks of losses. Risk control allows you to survive all of them without changing who you are as a trader. Without it, every losing streak feels like an emergency. You start searching for answers, changing strategies, abandoning rules. Not because the method failed, but because your emotions couldn't tolerate the pressure. Many traders say they understand risk, but their actions say otherwise. They increase size after wins. They hesitate after losses. That's emotion disguised as strategy. True risk control is boring. It doesn't care how confident you feel today. It doesn't care how perfect the setup looks. It applies the same limits regardless of mood. That consistency is what keeps emotions from creeping in through the back door. Losses are inevitable. Emotional losses are optional. A controlled loss hurts less not because it's smaller, but because it was expected. It was planned. It fits within the rules. An uncontrolled loss shocks the system. It triggers regret, anger, and the urge to make it back quickly. That's how accounts unravel. Risk control also builds trust with yourself. When you know you won't put the account in danger, you stop second-guessing. You stop watching every tick. You allow trades to develop. That trust reduces stress, and reduced stress improves decision-making. It's a quiet cycle, but a powerful one. The trader who ignores risk is always negotiating with his emotions. The trader who respects risk never has to. His emotions are managed before the trade even begins. That's why the best traders rarely talk about feelings. They talk about position size, stops, and exposure. Not because they lack emotion, but because they've already accounted for it. In the end, risk control is not about limiting profits. It's about preserving clarity. And clarity is the most valuable asset a trader can have when the market begins to move against expectations, when uncertainty increases, when pressure builds, and when every instinct urges action instead of restraint. Long-term success is built on boring decisions, and that idea disappoints most people when they first hear it. They come to trading expecting excitement, fast action, and dramatic wins. The reality is far less entertaining. The traders who last don't feel much while trading. They don't get a rush from clicking the button. They don't chase movement. They operate inside routines so dull they would put most observers to sleep, and that boredom is not an accident, it's a requirement. Excitement is a signal in trading, and it's rarely a good one. When a trade feels thrilling, it usually means too much is at stake. Either the size is too large, the plan is unclear, or the decision is being driven by anticipation instead of confirmation. Boring decisions come from clarity. They come from knowing exactly why you are in a trade and exactly what will make you leave it. There is nothing thrilling about that, and that's why it works. Most traders confuse activity with progress. They believe that doing more must lead to earning more. So they trade more markets, more time frames, more setups. Their days are busy, but their results are inconsistent. The trader who builds long-term success does the opposite. He narrows his focus. He repeats the same process. His days look similar, sometimes painfully so. Have you ever noticed how repetition feels uncomfortable, only when you're still seeking stimulation? Boring decisions are made before the market opens. Risk is defined. Scenarios are considered. Levels are marked. By the time price reaches a decision point, the work is already done. Execution becomes mechanical. There is no debate, no rush, no second guessing. That lack of drama is what protects capital over time. Drama invites emotion, and emotion invites mistakes. The market is very good at punishing traders who need excitement. It gives them just enough success to keep them engaged, then takes it back when confidence turns into carelessness. Boring traders don't fall into that cycle because they are not trading for entertainment. They are trading to operate a business. Businesses don't survive on excitement. They survive on predictable behavior and controlled risk. Long-term success also requires accepting long periods of inactivity. There will be days when nothing lines up, weeks where progress feels slow, months where results are flat. The trader who needs stimulation starts forcing trades during these periods. The trader who embraces boredom waits. Waiting feels unproductive, but in trading it is often the most profitable action you can take. Boring decisions also mean accepting small outcomes, small wins, small losses, small drawdowns. The desire for big results pushes traders into big risks. Big risks create emotional swings, and emotional swings destroy consistency. Wealth in trading is not built by one large trade. It's built by thousands of controlled ones. Each trade barely moves the needle, but together they create something durable. The money mindset behind boring decisions is rooted in patience and respect for probability. A single trade means nothing. 100 trades mean something. 1,000 trades tell the truth. That perspective removes urgency. When there is no urgency, there is no panic. When there is no panic, there is no need to act impulsively. Many traders sabotage themselves because boring feels like stagnation. They think if they're not learning something new or changing something, they're falling behind. In reality, mastery looks repetitive from the outside. The best traders refine instead of reinventing. They make small adjustments, not dramatic changes. They understand that stability is an edge in an unstable environment. Boring decisions also protect the trader's identity. When results are tied to excitement, confidence rises and falls with the market. When results are tied to process, confidence stays steady. You don't feel like a genius after a win or a failure after a loss. You feel like a professional doing his job. That emotional neutrality is not indifference. It's balance. The market doesn't reward passion. It rewards precision. Precision comes from doing the same thing the same way, even when you're tired, distracted, or disappointed. That kind of consistency cannot survive in a system built on excitement. It can only survive in a system built on routine. Over time, boring decisions compound. They reduce mistakes. They reduce stress. They reduce the need to recover losses quickly. They keep the trader mentally fresh and financially intact. The account grows slowly, unevenly, without drama. That kind of growth doesn't make good stories, but it builds real equity. The traders who disappear are usually the ones chasing intensity. They want trading to feel meaningful every day. The traders who remain are the ones who accept that most days feel ordinary. They don't measure success by how exciting the session was, but by how closely they followed their rules. Long-term success doesn't announce itself. It doesn't arrive with fireworks. It shows up quietly in the form of fewer mistakes, steadier behavior, and an account that survives conditions that wipe others out. And all of that begins with the willingness to choose the dull option when the exciting one is right there, calling for attention, promising more than it can ever deliver.